straight off, let's go to Mr. Rajiv Lal, Managing Director and Chief Executive Officer of IDFC. Mr. Lal, morning. Thank you for joining us. Before we look at specific verticals like power and fee-based income and what's happening to your mutual fund industry, first a word on the big picture for the quarter gone by.
Big picture, as I was saying in my introductory remarks a minute ago, on the margin things look better than they did 6 months ago, and that's because there seems to be greater clarity across the board on critical policy related issues. So on electricity tariffs, for example, a large number of states now have issued tariff orders substantially increasing tariffs, and most of them have actually passed tariff orders that allow for a pass-through for fuel prices. So that is very important and significant news for all power generators looking to sell electricity to state electricity boards, and that obviously should provide much greater comfort to the financing community because that secures and better protects the cash generating ability and therefore the debt servicing capacity of power plants that have been financed in the past. So that's one very important development. Likewise on fuel supply, on coal in particular, there is positive development with a number of projects looking to solve their fuel supply issues, and so the mood is slowly but surely lifting, I would say, on the most difficult subsectors of infrastructure.
Rajiv, what are the factors that have aided your profits this time around, and what has led to the increase in the spreads as well as the margins, and do you see this kind of growth actually sustain into FY13 too?
Yeah, so there are a couple of things that happened over the last 12 months. I think we have improved our market share. Our financing has been at very, very competitive rates, and that's because we have made very intelligent use of bond markets, which have also, through policy intervention by the Ministry of Finance, become deeper and more liquid than before with FII participation. So our competitors have been losing risk appetite. We understand risk in this sector better than most, and so we have had a little more pricing power than before. Our cost of funds have been competitive, and we've been taking away market share. That's been our story over the last 12 months in a very, very difficult macro environment. So my view is that if we can deliver this kind of performance in an environment such as the last 12 months, I feel quite confident that we can replicate the performance over the next 12 to 24 months.
Rajiv, but what is a bigger wrinkle or a hurdle for IDFC? Your exposure to power or your exposure to telecom?
Well, actually, all that information is shared in sort of great detail on our website. Our power exposure, first of all, has come down because we have deliberately and systematically shied away from projects as we have anticipated problems occurring. And we have managed, therefore, to protect asset quality. So if you look at our existing power portfolio, there is actually very little exposure to thermal power plants with, let's say, power purchase agreements with fixed tariffs. Almost virtually no exposure. And the few assets that have had fuel supply issues have systematically been resolved, and so we are very confident about our asset quality, which again reflects in our numbers quarter after quarter, year after year. our asset quality remains very strong. The power sector, from an asset quality point of view, is not a challenge. From a growth point of view, I think it does pose a challenge, because we will have to find ways over the next 12 to 24 months to keep up our growth momentum while not putting too much additional money to work in the power sector until we feel very confident that the issues pertaining to new projects coming on stream will be resolved quite to the same degree as existing projects. Telecom, again, as far as asset quality is concerned, we don't really have any concerns at this point. Obviously, if the business model for existing players becomes less lucrative and they are not able to pass on cost increases to the ultimate consumer, that will ultimately affect growth as well. But specifically with respect to IDFC, we have now a 60,000 crore balance sheet. In the scheme of things, relative to the size of the infrastructure opportunity, it is still tiny. It is still very small. We have less than 10% of the market. So even if headline growth for the sector declines, we don't see too many problems about continuing to grow our balance sheet from the size it is, at least for the next couple of years. Now, obviously, as our balance sheet size becomes larger, unless the wider macro issues become more constructive than they were last year, those challenges we'll face as and when we come to them.